Most people lose money in stocks, not because they're wrong about the story, but because they never check the price. I'm Alex. I hold about 70% of my portfolio in US stocks. If you're new here, welcome. I analyze the US stock market from a Canadian perspective, focusing on what Canadian investors care about most. No hype, just practical steps to navigate Fed moves, tariffs, and market dips. Today, I'll give you a simple 3-step checklist you can use on any stock to tell whether you're investing or just chasing hype. Every stock I look at goes through the same 3 filters. 1, valuation versus growth. 2, expectations versus reality. And 3, business growth versus stock price. If a stock fails any one of these, I stop. I'm going to walk you through each filter step by step so you can use this on your own watch list. I'm using Nvidia, not because it's good or bad, but because it's a perfect stress test. When a stock is this popular, weak analysis gets exposed very fast. Nvidia is trading at a PE of around 47 right now. Microsoft just dumped nearly $13 billion into OpenAI, and every CEO out there is talking about AI. So let's put this framework to work. Filter 1, valuation versus growth. This is where most people stop at PE ratio and call it a day, but PE alone doesn't tell you anything. You need to compare it to growth. That's what the PEG ratio does, price to earnings growth ratio. Here's the formula. Take the PE ratio, divide it by the expected earnings growth rate. If the PEG is below 1, the stock might be undervalued. If it's above 2, you're paying a premium, and you better be damn sure that growth is going to happen. Let's do the math for Nvidia. PE is 47. Analysts expect Nvidia's earnings to grow around 40% annually over the next few years because of AI demand. So 47 divided by 40 gives us a PEG of about 1.2. That's not crazy expensive, but not cheap either. Here's the thing. PEG isn't a fact, it's a bet on the future. That 40% growth assumes companies keep spending $1 trillion on AI infrastructure between 2025 and 2027 like Goldman Sachs estimates. If that spending slows down just even a little bit, Nvidia's earning growth drops, and suddenly that PEG ratio jumps to 2 or higher. That's when you know you're overpaying. So when you're looking at any stock, calculate the PEG ratio, and if it's above 2, ask yourself, am I absolutely confident this company will hit these growth numbers? If you're not sure, that's your signal to wait. Filter 2, expectations versus reality. Here's the rule. Forward PE tells you what the market expects. Trailing PE tells you what already happened. Trailing PE uses last year's earnings. Forward PE uses next year's expected earnings. If the forward PE is lower than the trailing PE, that means Wall Street expects earnings to grow. If it's higher, that's a red flag because it means earnings are expected to shrink. Let's look at Nvidia. Trailing PE is about 47, but the forward PE for next year is estimated around 30 to 35. That's actually good. It means analysts think earnings will keep growing and the stock will look cheaper next year if those earnings come through. But those forward estimates assume everything goes perfect. Companies keep buying chips, no recession hits, competition doesn't eat into margins. Now compare that to someone like OpenAI. They don't even have positive earnings yet. OpenAI lost $5 billion in 2024 on $3.7 billion in revenue. In 2025, they're expected to burn around $8 billion. Deutsche Bank says OpenAI's cumulative negative cash flow could hit $143 billion from 2024 to 2029. So you can't even calculate a PE ratio because there's no E, there's no earnings, and when you see this, you gotta ask, is there a clear path to profitability? How many more years of losses before they turn it around? For OpenAI, we're talking maybe 2029 or later. That's 5 years of burning cash. So here's your takeaway for filter 2. Always compare trailing PE to forward PE. If forward is lower, that's bullish. If there's no PE at all because the company's losing money, be very careful, unless you're okay waiting years for profits. Filter 3, business growth versus stock price. Here's the simple rule I use. If a company's PE ratio is higher than its revenue growth rate, that's a warning sign. Let me show you. Nvidia's PE is 47. Their revenue growth rate has been explosive, over 100% year over year in recent quarters. So 47 PE versus 100% revenue growth, that actually looks reasonable. The business is growing faster than valuation. But here's the problem. That revenue growth is slowing down. As the AI infrastructure build-out matures, Nvidia's growth rate is expected to come back down to maybe 30 or 40%. When that happens, you get a PE of 47 versus revenue growth of 30. That's a mismatch. The valuation is now ahead of the business. Here's what a lot of people miss. A stock can grow fast and still be overpriced. Growth alone doesn't justify any price. You need the price to match the growth rate. When PE starts running ahead of revenue growth, that's your signal the market is pricing in perfection. Now, here's where we check if those numbers even make sense in the real world. Adoption answers, is it used? ROI answers, does it pay? Markets care about the second one. McKinsey's 2025 survey shows 65% of companies are regularly using Gen AI. That doubled from the year before. Sounds great, right? But over 80% of respondents say their organizations aren't seeing tangible impact on enterprise level EBIT. So companies are spending money on AI. That's the revenue Nvidia and Microsoft are seeing. But those companies aren't making money back from AI yet. That's unsustainable. Eventually, CFOs are going to ask, why are we spending billions on this if it's not hitting our bottom line? When that question gets loud enough, AI spending slows down, and suddenly Nvidia's revenue growth drops hard. So forget Nvidia for a second. Any stock you look at, ask 3 questions. 1, does growth justify the price? Check the PEG ratio. If it's above 2, you're betting on perfection. 2, are expectations realistic? Compare forward PE to trailing PE. If forward is way lower, ask yourself if those estimates are actually achievable. 3, is the business growing faster than the stock? If PE is higher than revenue growth, the valuation is running ahead. You can use this checklist on anything. Tech stocks, dividend stocks, small caps, doesn't matter. These 3 filters will tell you if you're buying at a good price or if you're just chasing momentum. Using this framework, here's where I land on Nvidia. The risk reward doesn't work for me at current prices. That doesn't mean the company is bad, it just means the price leaves no room for error. I'd rather wait for a pullback. I want to see that PEG ratio close to 1 or below. I want to see proof that companies are actually making money from AI, not just spending on it. That's where the risk reward makes sense for me. But that's just how I apply the framework. You might have a higher risk tolerance or a longer time horizon. The point is, now you have a method to make that call for yourself. Run this checklist on your own watch list. You'll be surprised how many great companies fail it. In the end, this video is for information and sharing purposes only, not financial or investment advice. Always do your own due diligence. Drop a comment. What stock should I run through this framework next? Let me know.